Recently, China have reduced its reserve requirement ratio in April, and that has triggered some market actions expecting China to ease like 2015 and 2016. I think that market have misread the PBoC's information. The most recent RRR reduction is part of the longer-term initiative to move Chinese monetary policy framework from the total credit growth rate based system to an interest rate based system. I think that on one hand, they are actually asking banks to compete on the deposit rate because they have recently removed the window guidance. So therefore, that means that for banks, the overall funding cost will go up. And to reduce RRR actually is to offset this increase in cost for the banks. And this will allow the Chinese banks to have a lower funding cost and permanent base to replace all these medium-term lending facility. And therefore, we expect the RRR to be reduced further by another 150 basis points as part of the initiative to move towards an interest rate-based monetary policy framework. More recently, there has also been several meetings, like Politburo meetings and PBoC's quarterly monetary statement, and then the latest asset management business new guidelines. All these documents actually have suggested that there's a minor fine-tuning of the policy language. We are expecting the Chinese government to not to ease, so-called to remove the tightening bias of the Chinese credit policy and monetary policy. And I think that they are going to take a less aggressive stand on the overall financial deleverage. And as a result of this, we expect the overall total credit growth rate in China, which has been 12% in both March and April. And then in the second half of the year, we expect this total credit growth rate to stabilize or rebound. And at the same time, the market interest rate will continue to move up. Overall bond yield, we don't expect to fall further from here. And overall, we call it a neutral monetary policy rather than actually easing as many market participants have expected.